Hello, it's Elizabeth Pluswick with the video today about fixed costs, how they behave, variable costs and how they behave, the contribution margin income statement, and break-even point calculations, both on the graph and calculations, and then a check with the contribution margin income statement. Okay, let's get started. First, what are fixed costs? Fixed costs are costs that stay relatively stable, stay the same. We assume they stay exactly the same for a period of 1 year or the company's operating cycle, whichever is longer. Generally, it'll be 1 year's time. You assume that fixed costs will stay the same for 1 year. So here's a graph. Let's show you what the graphical representation of fixed costs would be. We have production levels here on the x-axis, and we have costs incurred on the y-axis. Fixed costs are going to be at a particular dollar amount. Let's say that is $10,000 per year. And no matter what the production level is, it'll stay the same at that $10,000 no matter how many units are being produced, right? Fixed costs are greater than zero and stay the same no matter what production is going on, 0 or 1,000,000 units produced. Examples of fixed costs might be rent on the factory, property taxes on the factory building. Straight line depreciation is a fixed cost. Actually, any depreciation except for units of production. We'll learn those later, but most depreciation costs are fixed for the year. Salaries are fixed for the year by contract, right? So those are examples of fixed costs. So in total, fixed costs stay the same, right? For the whole year. The same for the whole year. Per unit, fixed costs will vary, what? How related to production levels? Let's do a little example. If we have $10,000 of fixed costs and our production is 10,000 units, how many dollars of fixed cost have to be absorbed by each and every one of those 10,000 units? Well, $1 each, right? $10,000 of fixed cost, 10,000 units produced. Each unit absorbs a cost of $1 of fixed cost. What if our units produced, we have a bad year and it goes way down to we only produce 1 unit that year? We still have our $10,000 of fixed costs. So that 1 unit has to absorb or be costed with the entire $10,000 of fixed costs. So you can see that per unit, fixed costs vary inversely with the level of production. All right, that's fixed costs. Let's take a look at variable costs. As you can imagine, variable costs are costs that vary over the course of the year, and they vary with the level of production. So fixed costs will go up as variable costs will go up as production levels go up, and variable costs will go down as production levels go down. Variable costs will remain the same per unit, okay? So for example, let me write here, variable costs, you can have this in your notes, and we'll change the blanks here and see how variable costs behave. They're different than fixed costs. Let's give an example of a variable cost, direct materials. The more bicycles you make, the more bicycle tires you need to buy. So the more drones you manufacture, every drone has 1 camera, the more drones you manufacture, the more direct material cost goes into each drone, right? Because the more you manufacture, the more in total variable costs you have. We assume that variable costs stay the same per unit. So same per unit. Again, over that relevant range, generally 1 year's time and the relevant range of production. So in variable costs, in total, will change each year, will change directly in proportion to production levels. The more you produce, the more total variable costs you have. Per unit, fixed costs, they don't vary. They remain per unit, they remain the same. Per unit. No matter how many units we produce, per unit, those variable costs will remain the same. Okay, so let's draw what variable costs look like. They start with 1 unit. Maybe we have $100 of variable cost. $100 per unit of direct material. Direct labor is another example of a variable cost. If you make 1,000 units, variable cost will be what? 100 per unit times 1,000. So total variable cost would be $100,000 if we have 1,000 units, and it's $100 per unit of variable cost. If it's 0 units of production, then we have 0 variable cost. So you can see the variable cost line goes up at an angle, starts at 0 and goes up at an angle at the rate of cost per unit times the number of units being produced. Okay, what do you think about sales? What do you think about sales dollars? How do they show up on a graph like this? Well, we can leave all that. Let's see, let's just erase this part. Sales dollars, where do you think that origin would start at the on the graph? How do you think that origin of sales dollars would be? Well, as you can imagine, and I'm going to use green for sales dollars. You can imagine if you sell nothing, you have $0 of sales revenue. So the sales line is going to start right there. And if we're selling, say, sales price that we sell to the customers is $1,000 per unit. Okay, in our example, if we sell 1 unit, we have $1,000 of sales revenue. If we sell 1,000 units, we're going to have, what is that, $1 million of sales revenue? 1,000 units times $1,000 each. So the sales line goes up at a steeper curve than the cost line. But it would increase like that as well. Sales revenue in dollars. Start at the origin and go up. Let's draw again our cost lines. We had fixed costs going across like that, fixed cost. We had variable costs going at a slope about like that, variable costs like that. And then we can combine our two cost lines to total cost line. That's important to put on the graph. Total cost starts where the fixed cost comes in on the dollar side, and then it goes up at the same line slope as the variable cost line. So this would be the total cost line, which is the summation of fixed costs plus the variable costs. So take the variable cost line and just slide it up where it starts at the fixed cost line, goes up at that slope. Okay? So that's the total cost line. That's important because there's some important things to note on this graph. Where the total cost line and the sales revenue line intersect, total cost equals total revenue equals total cost. That's called your break-even point, right? Where total revenue is the same number as total cost at this level of dollars and at this level of production. Break-even point is important because then the company has 0 net income. You want to, of course, create and sell more than that, but it's important to know where that break-even point is in both units and in dollars, right? Everything to the right of that break-even point between sales revenue and total cost line, that is companies making net income or net profit, bottom line net income, net profit. Anything to the left of that sales revenue and total cost line, this area, companies experiencing a net loss, right? Their costs are greater than their total sales revenue. So I'll show you in the next video how to compute break-even point in both units and sales dollars. All right, we've gone over fixed cost definition and examples, variable costs definitions and examples, and break-even point using the graphical method. Let's find break-even point using equations now. The break-even point in units, BEP, in units, is exemplified by this, is calculated by this equation. Fixed costs in total plus target pre-tax net income divided by sales per unit minus variable cost per unit. Here's some example numbers here that we can use to figure out break-even point in units. So fixed costs in total, $100,000. plus target net income is 0 because we are just trying to determine break-even point, where total revenues equal total costs. Net income is 0. That's break-even point. So our target net income will be 0. And then divide by sales per unit. Customers pay $500 for each unit, minus variable cost per unit, $350. And that equals 100,000 divided by $150. Now that $150 has a special name. It's called contribution margin. So this right here, sales dollars per unit minus a variable cost per unit, has a special name. And we're going to use this more in a minute, but it says contribution margin. That's an important subtotal. Sales dollars minus variable costs per unit. So back to our example here, contribution margin in the denominator. So that would be 667 units. If they are produced and sold at $500 each, then our sales revenue would exactly equal our total costs, and the company would have 0 net income or net loss, just completely break even. Now let's say that we want to know our break-even point, but in sales dollars required. So we can tell the salespeople their target sales goals for the next month or year. So we want to have break-even point stated in terms of dollars, sales dollars, rather than in units. One quick change here to our denominator. Well, let me show you the shortcut way first. If you've already determined 667 units need to be sold, and you know the selling price, you can just multiply $500 selling price each, and 667 times 500, I think, is 333,000. Let's check. 667 units, each one sold at $500. Okay, so we get selling revenue required, 333,500. Okay, let's say then, that's our total sales revenue that we need in order to just break even. But let's say we haven't done this example yet, haven't come up with units. Let me show you just a way to get to that number directly. And that would be to adjust the denominator here just a little bit. You take this denominator and just divide it again by the same number, sales dollars per unit. So $500 in this case. Then this denominator becomes something called contribution margin ratio, okay? And so let's go back and use our numbers here again. 100,000 a fixed cost plus 0 net profit divided by 500 selling price minus 350 variable expenses per unit, and then divide again by $500 selling price. So let's see what that contribution margin ratio is. I think it works out to 30% in the denominator here, right? So 100,000 divided by 30% should give us the same. 100,000 divided by 0.3 gives us 333,333, which sales dollars required, which is close enough to our 333,500 that we used finding the units and multiplying it by selling price per unit. If you end up with partial units, always round up because you can't sell just a partial unit. So you have a little bit of rounding in these equations sometimes. So that's a way to get to the break-even point in sales dollars. Right? So we've done that in both units to be produced and sales revenue to be generated in order to cover all of the costs, both the fixed costs and the variable costs for that level of production. So the company just achieves 0 net income. Now you say, I don't want to achieve just 0 net income. I actually want to make some money. So all you would do then is for target net income, you would put whatever the pre-tax target net income is. Maybe it's $100,000. Maybe it's $500,000. Whatever the target net income is on a pre-tax basis, just put that up in the numerator along with fixed costs. Do your calculations, and you'll end up with sales dollars required to cover all of the expenses and have that much pre-tax net income left over. We'll go through an absorption variable costing income statement now. Okay, now let's look at a contribution margin income statement to prove out in this income statement format, and also to prove out your equations to see if we came up with the right break-even point in both units and sales dollars. And this is called a contribution margin income statement. Sometimes it's also called a variable costing income statement or variable cost income statement. It's used for internal purposes for management to make planning and budgeting decisions. It's not shown to outside stakeholders or investors, but it's a very powerful tool to do planning to see if the company is going to make net income or not, as costs change, as sales revenue changes, and as volume and units of production changes as well. So we've taken the same information here in our problem. So the contribution margin income statement has this format. Sales revenue always comes at the top. That's what customers have paid the company. Outside customers have paid the company to purchase the goods and services. Sales revenue is always the first line on an income statement. Then we subtract out variable costs and equals contribution margin. Should sound familiar. I put in the numbers here from the problem we just worked. Then next step is we will subtract fixed costs. Now we don't subtract fixed costs in the per unit column because fixed costs are just in total for the whole year, right? So we have another column here and we can have multiple columns with different levels of production. I've put in 667 units right here because that's what we've computed as our break-even point a minute ago. So sales revenue, $500 each, times 667 units, our sales revenue in total for the year should be $333,500. Our variable cost, $350 each, times 667 units, should be, that works out to variable cost 233 minus variable cost total 233,500, which leaves us with contribution margin of $150,000. I'm sorry, $100,000. 100,000. Ooh, that's messy. $100,000. Now we subtract the fixed costs in the total column here. So fixed costs in our example, $100,000. So we subtract that out and get net income or loss of 0. So that verifies that our break-even calculation of 667 units by the equation method was correct. We could also graph these amounts on the graph. What would happen if we, flexible budgeting, it's called flexible budgeting, where you can plan out varying other levels of production and predict what net income would be. So if we say, maybe we can make 1,000 units, what would our net income be at that point? So 1,000 units times $500 each sold would give sales revenue of $500,000. Variable cost then would be 1,000 units at $350 each. So that would be, variable cost in total would be $350,000, which would leave us with contribution margin for the year of $150,000. Then we subtract out fixed costs. Remember, they stay the same for the year. So it's still at $100,000 of fixed costs being subtracted, and we would end up with net income of $50,000 for that company if we produced and sold 1,000 units, and all of these numbers were estimated correctly. That is actually what we paid for variable costs and fixed costs in total. We'd end up with $50,000 net income. Now you could go back and try this with the equation method too, using 1,000 units, $50,000 target net income, and work those two equations and see if you get the same numbers here. Contribution margin income statement is a really nice proof of the equation method, and it's also a really good way to lay out for the accounting office, to lay out this internal income statement and to show your assumption of costs, units, and predicted profits. Thanks.